It's my pleasure to be part of the annual FIMMDA PDAI conference today. I would like to take this opportunity to place on record the Reserve Bank's deep appreciation of the key role played by FIMMDA and PDAI in the development of financial markets in India. Both organizations have played a significant role in improving the depth and liquidity of interest rate markets and in supporting primary issuance by the government. It's a matter of great satisfaction for me to be here and participating this with the presence of Shri S.B. Sastry, Chairman FIMMDA, Shri Sailendra Jingan, Chairman PDAI, Board of Directors and members of FIMMDA and PDAI, and other participants. I'm also happy to note the presence of some of my colleagues here. I think after the keynote address, you have two separate sessions where you have chosen very important subjects for panel discussion. So I'm sure you will have a very lively and very, positive, a very lively and a kind of very productive discussion in the coming, in the next two sessions. Now, let me now sort of focus on what I intend to say today. During the month of May last year, in one of my statements, I had noted that COVID-19 has crippled the global economy and that once again, central banks have to answer the call to the front line in defense of the economy. It has been more than a year since. While there are signs of recovery, we are still not yet out of the woods. The sudden shock delivered by the pandemic called for swift and decisive policy responses. Central banks across the globe responded by lowering interest rates, expanding their balance sheets through large-scale purchase of government securities and other assets, and injecting vast amounts of liquidity into the financial system. Many central banks also implemented measures targeting specific market segments that were witnessing heightened stress. These measures were in many cases complemented by regulatory relaxations, which consisted mainly of lower capital requirements and liquidity requirements. And these measures were aimed at supporting credit flow from banks and other financial intermediaries and at stabilizing the financial system and restoring confidence in the financial markets. The Reserve Bank, as you would be very much aware, Reserve Bank also responded swiftly and undertook several conventional, unconventional, and innovative measures in the realms of monetary policy, liquidity support, and regulation. The Reserve Bank, like most debt managers around the globe, was confronted with a highly expanded borrowing program of the government. Through various measures, the Reserve Bank completed the borrowing program in a non-disruptive manner and also created congenial conditions for other segments of the financial market, such as corporate bond markets. The stabilization of credit spreads across the rating ladder resulted in issuance of corporate bonds to the tune of rupees 7.72 lakh crore in 2021. In my address today, I propose to focus on the G-Sec market, which is the single most important financial market in any economy. Needless to add that this is a subject of great interest to both FIMMDA and the PDAI. The G-Sec market is distinct from other financial markets in a fundamental way. It is the market in which the risk-free interest rate, a key macroeconomic variable, is determined. G-Sec yields act as the benchmark for pricing of most financial assets. Without a well-functioning G-Sec market, therefore, the financial system cannot function efficiently. There are other distinctive features of the G-Sec market also. First, globally, the G-Sec market is predominantly an institutional market with major participants being banks and long-term investors, including investment funds, insurance funds, retirement funds. Second, different G-Sec instruments are highly substitutable, the only differentiating factor being the tenor of instruments. This is one of the reasons why the GSEC yield curve may be viewed as a public good, as I have been emphasizing. Third, GSECs provide the most widely used high-quality collateral for payment and settlement systems, liquidity operations, and other financial sector transactions. Fourth, and this is particularly relevant for a central bank, virtually all monetary operations are executed in the GSEC market. Monetary transmission is fundamentally linked to an efficient GSEC market in any market economy. So as you would have noticed, I first attempted to highlight the distinct features of the GSEC market. Now let me now highlight some of the important measures taken to develop the GSEC market and how this role provides the Reserve Bank with the critical levers to balance its multiple responsibilities during normal times as well as during periods of stress. Primarily, I will be focusing on the evolution of the government securities market in India. I would focus on the supply side issues. I will also focus on the demand side factors. Within the overarching statutory framework of the RBI Act 1934, the Government Securities Act 2006, and the Payment and Settlement Systems Act 2007, the Reserve Bank has enabled the development of when-issued trading in GSECs, short selling, repo transactions, interest rate derivatives, and the like. Further, to promote integrity, transparency, and fair access in markets, the Reserve Bank has introduced global best practices with the issuance of electronic trading platforms, ETP directions in 2018, directions for prevention of market abuse in 2019, and other sort of guidelines and instructions from time to time. As a consequence of these efforts, the legal and regulatory framework for GSEC markets has evolved over the years to facilitate efficient management of public debt and development of secondary markets. Now I would like to turn to the supply side, and here I would like to focus on the transition from monetization of debt to market-based debt management. The development of GSEC market was greatly facilitated by the abolition of automatic monetization of government debt, introduction of auction process for issuance and enactment of the FRBM Act in 2003. The next phase of reforms was directed towards institutional development, including the institution of primary dealers, establishment of the Clearing Corporation of India Limited, CCIL, which is, as you know, a central counterparty for guaranteed settlement, and importantly, formation of market bodies such as FIMMDA and the PDAI. Since December 2015, a medium-term debt management strategy has been articulated which revolves around three broad pillars, namely borrowing at low cost over a medium term, risk mitigation, and market development. Issuance of GSECs are made in different maturity buckets, enabling the formation of a yield curve up to 40 years. Secondary market liquidity is supported by building up issue sizes through reissuances. The consequent rollover risk is managed through active consolidation using buybacks and switches. Transparency in supply was enhanced through the introduction of the issuance calendars for auctions in GSECs since April 2002. Auctions are now conducted electronically, which ensure transparency as well as efficiency. Product diversity is ensured through various instruments, including inflation-linked bonds and floating rate bonds. Treasury bills and cash management bills are issued to smoothen government cash flows. Regulatory provisions for issuance of separate trading of registered interest and principal of securities, that is STRIPS, have also been made to facilitate the development of a zero coupon yield curve and to attract retail investors to the GSEC market. Going forward, it would be desirable for the Reserve Bank and market bodies like FIMMDA and the PDAI to work together to popularize the STRIPS instrument further. Niche products targeted at retail investors also include sovereign gold bonds and savings bonds. I would now like to focus on the demand side and highlight aspects of resilience amidst diversity. To impart resilience and diversity to the GSEC market, several steps have been taken to encourage direct retail participation. These steps include provision of non-competitive bidding in primary auctions and the odd lot segment on NDS-O, permitting banks, primary dealers, stock exchanges to act as aggregators or facilitators for retail investors, introduction of products for retail investors, and similar other measures. Interoperability is sought to be enhanced by linking market infrastructure, that is, linking exchange trading systems and NDS-O, and linking RBI's subsidiary general ledger system and the depositories. Foreign investors have been permitted to invest in GSECs subject to prudential limits. Recent initiatives like the introduction of the voluntary retention route, that is VRR, and fully accessible route, FAR, have contributed to demand side resilience. Non-resident participation in interest rate derivatives markets for hedging as well as trading has been permitted. The regulatory framework for hedging of foreign exchange risk has been liberalized to incentivize investors to hedge their currency risk onshore. Several other measures to promote ease of doing business by foreign investors, that is T+2 settlement of trades, extended timing for reporting of transactions, and allowing banks to fund margins for GSEC trades have also been taken. Market infrastructure is a key aspect of the entire GSEC market. So I would now like to highlight the market infrastructure and the state-of-art trade and post-trade services which have evolved and which have been facilitated and which have been put in place over the years. A sound, robust, and safe market infrastructure increases the resilience of GSEC market against external shocks and contributes to price discovery. The Reserve Bank has continuously engaged in developing state-of-the-art infrastructure relating to trading and post-trade services, including settlement, reporting, and timely dissemination of traded information, both in outright and repo markets. I can say with all humility that the infrastructure of GSEC market in India can be regarded as cutting edge in terms of sophistication. The NDS-OM system of the Reserve Bank, an anonymous order matching platform, provides multiple functionalities, which include trading in standard and odd lot sizes and trading in when issued market. This is in stark contrast to most jurisdictions, including advanced economies, where trading in government bonds is predominantly voice negotiated or fragmented over multiple electronic trading platforms. The NDS-OM is perhaps unique as it provides unparalleled pre and post transparency. It pools all market liquidity, providing a single order book, and it facilitates anonymity in trading, thus ensuring fair and non-discriminatory price discovery even for small investors. Complementing the trading infrastructure is a delivery versus payment-based guaranteed settlement. Complementing the trading infrastructure is a delivery versus payment-based guaranteed settlement mechanism, which eliminates settlement risks and through multilateral netting reduces liquidity requirements. This is one of the important features of GSEC market in India, as not many jurisdictions have central clearing of GSEC, let alone central clearing of all cash and repo transactions in GSECs at one place. In fact, there is growing discussion in advanced economies about the need for widespread adoption of central clearing after recent episodes of market dislocation. High levels of pre-trade and post-trade transparency are achieved through public dissemination of live orders and all trades being executed on the NDSO. Trade-wise historical data are available to all. End of the day publication of valuations of G-SECs by an independent benchmark administrator, namely the FBIL, improves price transparency. G-SEC markets need supporting markets in the form of funding market and risk markets. The repo market performs the function of a funding market. Similarly, interest rate derivatives markets enable management of risk. Comprehensive directions covering both OTC and exchange-traded derivatives were issued in 2019, rationalizing the regulations for eligible institutions, permissible instruments, exposure limits, and reporting. Futures and options have been introduced. Efforts to make the markets deep and liquid remain ongoing. I would now like to, let me now turn to the criticality of the G-SEC market for effective discharge of Reserve Bank's functions. And this is something which I alluded to in the beginning of my speech today. The Reserve Bank's multifaceted role as monetary policy authority, manager of systemic liquidity, government debt manager, regulator of interest rate and foreign exchange markets, regulator of payment and settlement systems, and overseer of financial stability makes the G-SEC market critical for the effective discharge of all these responsibilities. With the development of domestic financial markets and deregulation of interest rates, effective transmission of monetary policy impulses relies on G-SEC market being deep and liquid so as to create the intended impact on interest rates by linking expectations of future short-term rates to current long-term rates. Similarly, a well-functioning G-SEC market ensures efficient discharge of public debt management function. The public debt structure, that is quantity, composition, and ownership of debt, also influences monetary conditions. In the wake of the pandemic, when fiscal response resulted in a sharp increase in government borrowing, the market operations conducted by the Reserve Bank not only ensured non-disruptive implementation of the borrowing program, but it also facilitated the stable and orderly evolution of the yield curve. Monetary policy, G-SEC market regulation, and public debt management therefore need to be conducted in close coordination, and the primary focus of such coordination is the G-SEC market. The current arrangements of G-SEC repository residing with the Reserve Bank facilitates seamless conduct of liquidity operations and simultaneous settlement of G-SEC trading. This provides confidence to investors, removes custodial risk, and minimizes transaction costs. Access to real-time market intelligence arising from ownership, oversight of market infrastructure is critical for fine-tuning of timely policy responses. The Reserve Bank's regulation of G-SEC market has also a strong synergy with its role as the banking regulator, as banks are the largest category of participants in these markets. The importance of this aspect is also highlighted in the recent G30 report, which identified the balkanized regulation of the US Treasury markets, where banking regulations seem to have adversely impacted market making. The current regulatory arrangement for G-SECs offers synergies in terms of a unified market for G-SECs, repo in G-SECs, liquidity and other monetary operations, exchange rate management, regulation of key derivative markets, public debt management, and prudential regulation of banks, the largest category among the market participants. The synergy between Reserve Bank's responsibility for key market variables namely interest rates and exchange rates, which ensures overall financial market efficiency and its obligation to ensure stability while keeping in mind the objective of growth is well accepted. Indeed, its effectiveness, that is Reserve Bank's effectiveness in managing stress in foreign exchange and interest rate markets, is made possible by direct access and oversight of the GSEC market. I would now turn to the agenda for the future. The size of the Indian GSEC market, measured in terms of outstanding stock as a percentage of GDP, is large relative to most Asian peers. Liquidity measured through average bid-ask spreads for Indian GSECs is among the best as per a recent, as per a 2019 BIS study. The GSEC market has also provided a robust backbone for the development of the corporate bond market. Notwithstanding the robust evolution of the GSEC market in India, there is scope for further development to remain in sync with the emerging requirements. First, secondary market liquidity as measured by turnover ratio is found to be relatively low on several occasions and tends to remain concentrated in a few securities and tenors. The yield curve accordingly displays kinks, reflecting liquidity premium commanded by select securities or tenors. To a certain extent, this is the result of the market microstructure in India, dominated as it is by the buy and hold and long only investors. We need to develop a yield curve that is liquid across the tenors. Second, expansion of the investor base is key to further development of the market. The RBI, together with the government, is making efforts to enable international settlement of transactions in GSECs through International Central Securities Depositories, that is ICSDs. Once operationalized, this will enhance access of non-residents to the GSECs market, as will the inclusion of Indian GSECs in the global bond indices, for which efforts are ongoing. To encourage direct retail participation in GSECs, RBI has announced the Retail Direct Scheme, a one-stop solution to facilitate investment in government securities by individual investors. The third aspect which I would like to highlight is that liquidity in GSEC markets tends to dry up during periods of rising interest rates or in times of uncertainty. While the market for special repo facilitates borrowing of securities, it is worthwhile to consider other alternatives that ensure adequate supply of securities to the market across the spectrum of maturities. It may be recalled that discussions were held on the introduction of securities lending and borrowing mechanism (SLBM) with a view to augment secondary market liquidity by incentivizing buy and hold type investors, that is, insurance companies, pension funds, etc., to make available their securities to other market participants. Useful feedback was received on the subject from FIMMDA and the PDAI. I would urge that these discussions be carried forward with a view to evolving market-based mechanisms that enable the lending and borrowing of securities as part of overall market development. Fourth, the interest rate derivatives, that is the IRD market, has evolved over the years with the availability of a wide range of products. The only major liquid product, however, continues to be the Mumbai Interbank Offer Rate, that is MIBOR-based overnight indexed swaps market. Participation in the interest rate derivative markets is also largely limited to foreign banks, private sector banks, and primary dealers. I am happy to note that based on RBI directions, FIMMDA formulated operational guidelines for trade in swaptions in consultation with market participants, and trading in swaptions have commenced. And this is a point which I think Mr. Sastry had mentioned in his opening remarks. It is also an opportune time to consider new instruments to facilitate hedging of long-term interest rate and reinvestment risk by market participants such as insurance companies, provident and pension funds and corporates. On its part, the Reserve Bank will endeavor to ensure adequate liquidity in the G-Sec market as an integral element of its effort to maintain comfortable liquidity conditions in the system. In my monetary policy statement of 6th August this year, that is 6th August 2021, I had set out a roadmap for gradual restoration of the variable rate reverse repo auction, that is VRRR auction, as the main operation under the revised liquidity management framework announced on 6th of February last year, that is 2020. In order to facilitate this process as markets settle down to regular timings and functioning and as liquidity operations normalize, the Reserve Bank will also conduct fine-tuning operations from time to time as needed to manage unanticipated and one-off liquidity flows so that liquid conditions in the system evolve in a balanced and evenly distributed manner. Let me now conclude by saying that government securities are, as I have already stated, government securities are a distinct asset class. It is important to appreciate the role the G-Sec market plays in the overall macro interest rate environment of the economy. Over the years, the market for G-Secs and associated market infrastructure have reached a stage where it could be considered as one among the best in the world. These developments have taken place in tandem with efforts to develop and liberalize other key financial markets, such as markets for interest rate derivatives and foreign exchange markets, together with efforts to build linkages across different markets and market infrastructure. We have come a long way in developing financial markets in the country, but this is a continuous journey, and together we can make it even more robust and vibrant. Thank you. Thank you for this opportunity and your patient hearing. Thank you.